This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only. Now, here's Shane and Diana.
Hi everyone, hi Shane.
Hi B.
So we've seen shares hitting new record highs multiple times in the past few months, both in Australia and abroad, delivering great returns for a lot of balanced fund members. So can this continue, Shane?
Well, that's a good question. Back in Australia, of course, we've been a bit of a lag, and we'll come back to that. We hit a record high back in March. And of course, the US share market has continued to hit record highs. And part of that's on the back of enthusiasm about artificial intelligence, with NVidia doing fantastically well. I guess, yes, the big question is, can that continue? I'd have to say there are a lot of uncertainties around. Mind you, you could have said the same thing a year ago, but share markets have managed to climb a wall of worry through that period, particularly as inflation rates globally fell and central banks pivoted towards rate cuts, obviously with 4 central banks already having cut rates in the developed world. That's Switzerland, Sweden, Canada, and of course Europe. And the US, of course, looks to be getting closer to a cut probably in September. So I think that's the big positive going forward. And I guess there is a risk, though, that we could have a recession. So that's a reason to be a little bit cautious. There's a lot of geopolitical risk around. The French election has created some uncertainty about the rightward shift in parts of Europe and tensions between various country governments and what the European Commission wants regarding fiscal policy. So there's a bit of an issue there. There's issues in the US with the upcoming election in the US, which could see the return of former president, Donald Trump, leading to tensions around budget deficits, inflation, the central bank, tariffs, all those sorts of things, which could cause some volatility. And of course, share markets are somewhat expensive. You know, if you look at the yield pickup that shares offer relative to bonds, it's actually quite low, particularly in the US share market. So I think at the very least, you'd have to assume that returns will slow down, and we're probably going to have not only more constrained returns over the next 12 months, but somewhat more volatile returns. But as mentioned, our base case is that as interest rates come down, hopefully any recession that we do have, it's not our base case, but if we do have one, it will be relatively mild. And therefore you look back in 12 months' time and you'll say it's been okay, but maybe not as strong as the returns we got through 23, 24. I think one of the interesting things from all of this, though, has been the relative underperformance of Aussie shares. Over the last 12 months, Aussie shares returned 12% on their own. That's fantastic if you didn't know anything else, but global shares have returned 20% plus. And a lot of that comes back to talk of higher interest rates in Australia. So what do you make of that? Over the last week or so, we've seen quite a lot of new developments in terms of economic data in Australia.
Most of the things that you mentioned, there are more worrying things than positive things at the moment, it seems. And especially in Australia, I think there have been a wave of upside surprises in a lot of data in the past 2 weeks. So we've had, a blowout in CPI monthly indicator. It came out 4% rather than the 3.6% we were thinking. We've had upside surprises in retail sales and building approvals. So it just looks like...
And home prices still rising.
Oh yes, and home prices hit another record high. Like, it is sad news for a lot of people right now. And it just looks like a hike might be back in play for the RBA in the next few months.
Yeah, some of that is a case of good news might be bad news. If things are too strong, then of course you end up with potentially higher interest rates, another rate hike, or higher for longer rates, which I must admit is a disappointment. I would have thought a long time ago that rates wouldn't have got this high, and we would have thought that by now we would have been seeing rate cuts, but the inflation number has put paid to that. I must admit I'm not as gung-ho on another rate hike. When you go through some of that data, if you look at the simple one, building approvals, it still remains very low. I think it's in a note you pointed out, it's consistent with home building of around 161,000 dwellings, whereas we need to be building like 240,000, 250,000, 240,000 is in fact the target of the housing accord in Australia. So still got very low home building numbers. And of course, the recent bounce was driven by approvals for units, which can be very volatile. Retail sales, we saw something in November last year. The sales that used to occur, the discounting that used to occur in December and June has now been brought forward. And so maybe that's having a factor. It boosted sales in November last year, then you get a weak December, and now it seems to have had the same thing boosting sales in May, and so we may get a weak June. And likewise, when you look at the CPI, that monthly CPI does tend to bounce around a lot. So we really got to look at the June quarter numbers before we can get too confident about what's happening with inflation. You could also point out that we've had 3 monthly inflation numbers on the hot side in Australia in a row, March, April, May. Guess what they had in the US? 3 hot numbers in a row, January, February, March. Everyone started talking about rate hikes in the US potentially. And then, of course, we got the softer numbers through April and more recently, particularly in May. So maybe we'll go through a similar pattern in Australia. Fingers crossed, touch wood, all that sort of stuff. And hopefully that will be the case. The other thing to note is job vacancies. And I think you've done a little bit of a look at them, and they seem to be going in a less positive direction.
Right now, it's almost guaranteed that if you want a job and you have the right skills, you can find an opening out there for you. But it is getting much and much harder over the quarters in the past year.
So I think it's fallen for, 8 quarters in a row.
It is, yeah, it has.
Yeah. It's a similar story in the US. What they call job openings in the US have come down. And some would say that that's a leading indicator of the labour market, both in terms of wages growth and also employment, and warns us that even though things are still quite tight, unemployment in both countries, the US and Australia, is quite low. If there's not as many job vacancies out there, then that's a sign that labour demand is actually slowing down.
I guess it is going to become more tough for consumers out there because inflation is still very high and wage growth is already starting to slow a little bit. So household budgets are going to be tightened much further. And we've seen that in the retail sales data as well. People have cut back quite a bit on discretionary spending. You do see people buying a little bit more fun stuff. Say last month, people buy a bit more cosmetics.
What do you call the lipstick
The
effect?
lipstick effect. Because so historically, during recessions, you see more people buying the little luxuries, like a lipstick or say ice cream, not because they can afford it, a lot of it, but more like so.
But doesn't gambling go up in recession or downturns as well? People are feeling bad, so they want to gamble a bit more to relieve the stress, even though it's a hopeless exercise.
Yeah, people can't buy big things like you can't buy a house at the moment because rates are high and affordability is low. So what do you spend money on? You spend on the little things like that. So it is true that the details are definitely not as strong as it looks for the Australian consumers and global consumers as well.
Which is why I think the Reserve Bank would be wise to stay where they are. If you keep tightening just because you haven't got the inflation number you've got, but there's a lag in there, you end up like what Milton Friedman once referred to as a fool in a shower. And that is, just imagine a cold winter's morning in Australia. You turn on the hot water tap and nothing comes out. It's all cold, and you lose your patience. You keep winding up the dial to get hotter and hotter, and suddenly it comes through with a rush, and you end up scalded. I kind of worry that our central bank could end up the same way if they keep tightening. So what's happening with eggs and why the concern?
Funnily enough, the shortage might actually be real. So if you see the headlines, McDonald's or Macca's in Australia have cut back their times of serving breakfast. They used to serve breakfast until midday every day, but now they only serve it until 10:30 a.m. because there is a shortage of eggs. And I think we're definitely going to see a little bit of this noise in the CPI data coming up.
I mean, the obvious concern is what this means for the Reserve Bank, because higher egg prices, higher CPI prices, and therefore maybe higher inflation. I guess the flip side, though, is it's a bit like oil prices. When they go up, if people can afford to pay the extra amount and keep spending, then you don't worry about it so much because, it's just one commodity. But if alternatively, it does actually act as a tax on spending, people say, well, I've got to pay this extra amount on eggs. My budget's already been hit, and therefore I have to cut back further on discretionary spending. It's something the Reserve Bank wouldn't be too concerned about. I guess you could also argue that eggs are a very small portion of the overall CPI basket, so it's not going to have a huge effect unless it does something like banana prices did after a cyclone a few years ago, when banana prices literally went through the roof, and that led to a temporary boost in the CPI.
Are you worried though? Because to be fair, egg prices eggs are the raw materials that go into a lot of other things. Say if you go out eating brunch, that would push up services prices again because that's dining out prices.
Well, you have to see it as a concern, but I kind of think if it's something that's occurring in isolation due to something the Reserve Bank can't control, it's not a generalised effect, and it's at a time when consumer spending is already limited, it acts more of a negative for households. And so, yes, they have to pay more for these things, but they've got less money to spend elsewhere, which means less discretionary spending, which pulls down the prices of other things. So I wouldn't be too concerned about it, but it's news we probably don't really want to have, to be honest with you.
All of us actually get a tax cut from this week onwards. We with the stage 3 tax cuts coming into play. So we actually do have a little bit more money in our pocket. Are you concerned about that as well?
Well, a little. There's no doubt that the rearranged. So originally, the stage 3 tax cuts were the final stage in a 3-stage series of tax cuts, and the first 2 stages were aimed at lower and middle income earners. The final stage was aimed mainly at higher income earners and pushing out that top threshold from 180,000 to 200,000. Then the government earlier this year decided, well, that's unfair. Low and middle income earners aren't getting much from this, so they spread the tax cuts more down the scales. Some would say, well, that's adversely affected the economic reform that was initially proposed, or that was the aim of the stage 3 tax cuts, and that's a bit of an issue. But one of the risks was always that if you give bigger tax cuts to low and middle income earners, yes, you might get more votes. And the problem is that low and middle income earners spend more of their income than high income earners, and therefore you get a boost to spending in the economy. So that's certainly a concern, and that's why I think the Reserve Bank will certainly want to see what the impact will be from these tax cuts. The flip side, though, is we've still got the impact of high interest rates coming through the economy. That hasn't been reversed. The tax cuts is about $37 a week for someone on 90,000, which is average earnings, only covers a very, very small fraction of the amount by which they're behind from the higher interest rates. So there's not a massive boost there. And the other aspect, I guess, is that the jobs market is deteriorating. The job vacancies flow through to lower employment or higher unemployment at a time when we've still got strong population growth. It probably means higher unemployment. Then that will act as a drag, and any boost that you get from the tax cuts will be offset by a weaker jobs market. So it's all a bit uncertain at present just which way this thing goes. It's just my inclination is to think, yes, there's a lot of balls in the air, but the more sensible outcome for the Reserve Bank would be to sit tight rather than move again and raise interest rates, because I think that would risk knocking us into recession unnecessarily at a time when demand is already quite weak and inflation should slow based on what's happened in other countries. I just want to end on one note here, and that is I discovered or read somewhere that in the Journal of Financial Economics that these academics had actually done a study which showed a correlation between the strength of share markets and the positivity of the music people are listening to. So if you've got a lot of positive music around, happy songs, then it tends to be good news for the share market, which is why I think it's very, very important to listen to positive, happy songs.
You have any suggestions for us this week?
Well, there's 2. For some reason, I've just come across, I often, at the end of each night, I listen to or watch YouTube, and you just endlessly scroll through pop songs. And one I came across was one that I really loved, because when I was a little bit younger, U2 and Gloria Estefan had a hit with a song called Everlasting Love. But that was actually a cover of a song that a group called Love Affair, a British group, recorded in the late 1960s. They had a big hit with it, but it only charted in the UK. So in disappointment, they split up. But it was interesting to see that song become a hit for U2 and Gloria Estefan. So that song's worth checking out. I'd go to YouTube and watch the original clip to Everlasting Love. Another one is one that I was listening to a lot in the late 80s, maybe after the 87 crash, which wasn't a great event. But of course, the aftermath of that wasn't too bad. And it was called Yaz. It was by Yaz and the Plastic Factory. And I think it was called The Only Way Is Up or something to that effect. So those 2 songs are worth having a look at. Yaz and the Plastic Factory and Love Affair's Everlasting Love.
The only way is up in the long terms for markets and for the Australian economy.
Just got to make sure you don't get thrown off by the cyclical downswings.
Will do. Thank you, Shane.
Thanks, mate.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.